So if you're an S-corp owner, listen up. There's this number, a kind of hidden number, that could land you with a surprise tax bill. It's called shareholder basis. And believe me, it's something the IRS is now watching very, very closely. Let's break down exactly what you need to know.
All right, let's play this out. Picture this. Your S-corp has a tough year, and it ends up with a $25,000 loss on the books. As the owner, it just seems logical that you should be able to take that loss and deduct it from your other income on your personal return, right?
Well, you'd think so, wouldn't you? But it's not that simple. The answer isn't a straight yes or no. It all comes down to this one number that you won't find on your P&L or your balance sheet. It's your shareholder basis. Now look, this number has always been important. But now the IRS has it under a microscope. And why? Because they found out that a whole lot of business owners were deducting losses they just weren't entitled to. So what was their solution? A brand new mandatory form designed to track every single dollar of your basis.
Okay, so here's the game plan for today. We're going to start with why the IRS is suddenly cracking down on this. Then we'll get into what basis actually is and how it kind of goes on a roller coaster ride. We'll take a look at the new form you need to know about, and we'll finish up in what I call the danger zone, the common mistakes that can get you into some serious trouble.
All right, let's kick things off. Section 1, the IRS's new focus. Why is this all of a sudden such a huge deal?
For the longest time, tracking your basis was pretty much on the honor system. The IRS just kind of trusted you to do it. Then in 2018, they added this little checkbox to the tax forms, sort of like a gentle nudge saying, hey, you're doing this, right? Well, it turns out a lot of people weren't. So now that gentle nudge is gone. Poof! It's been replaced by Form 7203, which is separate and it's totally mandatory. There's no hiding from this calculation anymore.
So that begs the question, what is this number that the IRS is so obsessed with? Let's get right back to the basics.
Okay, let's just boil it down. In the simplest terms, your shareholder basis is your total economic investment in the company. Think of it as what you personally have at risk. It's your skin in the game. It's not about the company's value, it's about your stake in it.
And this basis number is actually made up of two parts. First, you've got stock basis. That's the money or property you put in to get your shares. Simple enough. But then there's debt basis, and this is where people get tripped up. This only gets created when you loan money directly from your own pocket to your company. Now, here is the really, really important part. Just co-signing or guaranteeing a bank loan for your business, that does not give you debt basis. You only get it if the loan comes straight from.
All right, so this basis number isn't something you calculate once and then just forget about. Oh no, it's a living, breathing thing that goes up and down every single year. It's a real roller coaster.
Probably the easiest way to wrap your head around this is to think of your basis like a checking account for your investment. You make deposits, you make withdrawals. But there's one golden rule, and you absolutely have to remember this. That account balance can never, ever go below zero.
So what counts as a deposit into this account? Well, first, any new capital you contribute. Second, your share of the company's profits. When the business makes money, your basis goes up. And third, any new direct loans you make to the company. These are your deposits into the basis account.
And the withdrawals? Well, distributions you take out are a big one. Your share of the company's losses also reduces your basis. And here's a sneaky one that gets a lot of people. So do non-deductible expenses, like that 50% of meals that you can't write off. Even though it's not deductible, it still eats away at your basis. And finally, when the company pays you back for that loan you gave it, your debt basis goes down.
So with all these ups and downs, how does the IRS want you to report everything? Well, that brings us to the new tool in their arsenal, Form 7023.
So when do you have to file this thing? Listen closely. You've got to attach it to your personal tax return if any of these four things happen. You claim a loss, you take a distribution, you sell your stock, or you get repaid for a loan you made to the company. In short, if money is moving between you and the business in almost any significant way, this form is probably required. And the form itself walks you through a pretty logical three-step process. Part I is where you calculate your stock basis, all those deposits and withdrawals we just talked about. Part 2 does the exact same thing but for any loans you've made. And then finally, Part 3 puts it all together to determine the exact amount of any losses you are legally allowed to deduct.
So what happens when you don't have enough basis to cover your losses or your distributions? This is where things get dangerous. Welcome to the basis danger zone.
Check this out. Let's look at two shareholders. They both take a $25,000 distribution. In the good scenario, the owner has more than enough basis to cover it. The distribution is tax-free, life is good. But in the bad scenario, the owner only had $16,000 of basis. That means the extra $9,000 they took out, it becomes a taxable capital gain. Boom. They got a surprise tax bill just for taking money out of their own company.
Now, you might be thinking, hold on a minute. If the business was losing money and had low basis, where on earth did it get $25,000 in cash to hand out to the owner? That is the perfect question to ask.
And that is the trap. This is the single most common trigger for basis problems. The business goes to a bank and takes out a loan. Suddenly, the company checking account is flush with cash. The shareholder sees that cash and distributes it. But remember what we said earlier? A company loan, even one you guarantee, does not increase your shareholder basis. The cash is real, but the basis that makes it tax-free simply isn't there.
So what's the ultimate takeaway from all of this? The IRS has made it crystal clear. The legal responsibility for maintaining an accurate, running calculation of your basis falls squarely on your shoulders, the shareholder. Not the corporation and not your accountant. It's on you.
Which leaves us with one final thought. You look at your S-corp's bank account and you see a healthy cash balance. But after everything we've talked about, you now have to ask yourself a new question. Is that cash really yours to take, tax-free? Or is there a hidden tax bill waiting for you, all because of your basis?